Here's a bold statement: Pakistan's economic stability hangs in the balance, but the International Monetary Fund, IMF, believes it's found the secret sauce: a tight monetary policy and proactive financial measures. But here's where it gets controversial: can these strategies truly withstand the country's ongoing challenges, especially after devastating floods? Let's dive in. As of December 12, 2025, the IMF has praised Pakistan's, appropriately tight, monetary policy as a cornerstone of its macroeconomic resilience. Despite the chaos caused by recent floods, the State Bank of Pakistan, SBP, has kept inflation expectations in check by maintaining a policy rate of 11%. This move, according to the IMF staff-level report, has been instrumental in navigating temporary supply shocks. And this is the part most people miss: the SBP's data-driven approach has consistently kept inflation within its 5 to 7% target range over the medium term, no small feat in such turbulent times. The IMF commends the SBP's dual success in managing inflation risks while fostering economic recovery. Their efforts to strengthen the monetary policy framework, improve communication, and enhance transparency, through semi-annual reports and revised consumer surveys, haven't gone unnoticed. But the IMF also warns, vigilance is key. Monitoring flood impacts on inflation and external positions remains critical, and the SBP must be ready to act decisively. On the foreign exchange front, the SBP's efforts to rebuild reserves and deepen the interbank FX market have been spotlighted. The recent revision of foreign exchange exposure limits, FEL, for banks, for instance, has provided much-needed flexibility in managing FX flows without compromising risk management. Yet, the IMF encourages Pakistan to go further, enhancing remittance channels and unwinding certain capital flow measures once stability is restored. Here's another point that might spark debate: Pakistan's push to develop capital markets, strengthen anti-money laundering, AML, and counter-terrorist financing, CFT, frameworks, and regulate emerging sectors like virtual assets. While the IMF applauds these efforts, it emphasizes the delicate balance between fostering innovation and ensuring investor protection and financial transparency. Is Pakistan doing enough to strike this balance? Let us know your thoughts in the comments. The IMF concludes that Pakistan's comprehensive approach, bolstering reserve buffers, deepening the FX market, and advancing financial reforms, positions it to weather short-term shocks while supporting long-term growth. However, as the country grapples with persistent economic challenges, the IMF underscores the need for a tight, data-dependent monetary policy, robust financial regulation, and a flexible exchange rate to sustain stability and investor confidence. So, what do you think? Can Pakistan's current strategies truly secure its economic future, or are there gaps that need addressing? Share your insights below. We'd love to hear your take.